Welcome to the classes. Let me first explain to all of you how we are going about with this classes for CA Final Advanced Accounts. Any subject before we start, first we should have an approach for ourselves, which approach will suitable for the confident handling of that particular paper. Advanced Accounts is the first paper for the CA Final. The paper is for 100 marks and altogether you need to answer 6 questions. Friends, please remember, unlike your PE2 or PCC, the number of topics you have at the final level are relatively less. In the sense, you have only 3 topics to concentrate, like valuation of shares, and then you got amalgamation and reconstruction, and then we got holding companies and subsidiary companies and consolidation of the financial statements of the holding company and the subsidiary company. We have some more topics like human resource accounting, inflation accounting, and then corporate social responsibility and reporting and accounting, and accounting for non-profit organizations. But major concentration, if you look at, definitely these are the 3 important topics: valuation of shares, amalgamation and reconstruction, and the holding company and the consolidated financial statements. Then we have in the final the task of understanding the accounting standards and doing problems on accounting standards and different guidance notes issued by the Institute of Chartered Accountants of India. 35 to 40 marks. The paper comes from accounting standards and the problems based on the accounting standard. One question of these 6 questions, which carries 20 marks, they are asking specifically the questions on accounting standards. 10 marks you have to answer 2 bits in a particular question, which are specifically tested from the guidance notes issued by the Institute of Chartered Accountants of India. Then of course, conventionally, any person who sets the paper need to necessarily ask you the questions from holding company, valuation of shares, and amalgamation and reconstruction. So ultimately what the point is, equal thrust is there for these 3 topics and the accounting standards and the guidance note. So in these sessions, how do we go about? First, I will start with a topic over which already you got some basic understanding, that is the topic of amalgamation and the reconstruction. This topic at its preliminary level you might have done at PE2 and PCC level, but there it is only a cut and eraser, just to make you to understand the accounting standard 14. You have a topic there at, but all the intricate issues with at least 10 to 15 models we have at the final level to learn to account for amalgamations and reconstructions and corporate restructurings like demergers. So here the topic is divided into 12 to 15 models and we will be solving the problems accordingly. About 25 to 30 practical problems you are going to do. But again the issue is, when we want to do the practical problem, first we should be clear with the concept and we should be clear with the journal entries for the different situations. Once the student is thorough with the basic accounting concept associated with the amalgamation and reconstruction, and then if he is perfect with the journal entries, rest is only a procedural aspect. So in that context, in this session what we will do is, we will try to do with the standard and the accounting aspect which the standard is asking us to learn, and then I will explain in detail what is purchase consideration and what are the different models of computation of purchase consideration, and then we will learn and discuss the accounting entries in the books of vendor company and in the books of the purchasing company. Of course, if you still remember that particular amalgamation which you studied at the PE2 level, major issues at that level are how do you account for intercompany owings, intercompany stock, intercompany holdings, and accounting for the goodwill on account of acquisition of one company by the another company. And at this level what you have is the cross holding, that is vendor company is holding shares in the purchasing company is holding the shares in the vendor company. How do you account for such a situation, and finally what will be the effects while closing the vendor company books and what will be the effects while incorporating the same into the books of the purchasing company. Many fresh issues you have in the final other than this cross holding, spin-off transaction, and without liquidating the other company, how one company is completely making the other company a subsidiary, and in that situation how do you account for the same complete spin-off transaction, how to account for that, we have to do it. With this brief introduction about the topic, let me get into the topic proper. Accounting for amalgamations and reconstruction, basically first aspect of it is how the scope is being defined by the accounting standard 14. So accounting standard 14 as such has taken care of what? Amalgamations which are covered by the Companies Act 1956 or any other statute which is applicable to the companies. So here the standard says that amalgamation does not cover the acquisition. Acquisition is something like without liquidating the other company, you are purchasing the major shares of the other company. Thereby in an acquisition process, most of the time what will happen, the other company will become a subsidiary company to this particular company, which we are not terming it as an amalgamation. So amalgamation, what we mean, status of a separate legal entity of the two or more entities vanish. In the sense, conventional definition of amalgamation is two or more companies will go into liquidation and a new company will be formed to take over the business of both the companies. Consequently, the companies which are vendor companies will be losing their legal entity and a new company will be formed. Once you talk about absorption, of course, which is not there now, all sorts of corporate acquisitions you are asked to treat them as only amalgamation. But conventionally, what is absorption? One or more companies will go into liquidation, an existing company will take over the business of the companies which are going into liquidation. So purchasing company is there earlier and will continue to be there. It's not going to lose its separate legal entity. What is going to lose the separate legal entity is only the vendor company. And here an example is given to you. If X Limited and Y Limited are liquidated and a newly formed company Z Limited acquires the two businesses, it is termed as amalgamation. And X Limited and Y Limited, we call them as a transferor companies, and Z Limited we call it as a transferee company. Whereas in case of the absorption, what we are saying is, if X Limited is taken over by Y Limited, it is referred to as absorption. Here there is no formation of a new entity, but there are one or more liquidations. X Limited is termed as transferor company, Y Limited is termed as a transferee company. Now what we are saying is, it is safe to assume that the connotation of the term amalgamation also includes absorption. This is what we exactly mean. That is, with introduction of the accounting standard 14, absorption lost its relevance. All corporate acquisitions are to be treated as only amalgamations. Now coverage of AS 14, it excludes what? There are circumstances in which one company can obtain control over the another without disturbing the status of each company. That is, that the other company continues to maintain its separate legal entity, yet deriving the benefit of coming together. This is happening by what? By acquiring the shares in the other company instead of acquiring the business of the other company is the point. Of course, such kind of situations, how do you account for? We have an accounting standard 21 which deals with the consolidated financial statements. Because if you merely acquire the shares of the other company is becoming a subsidiary company to you, and at the end of the every financial year, once for a particular company it has got 3 or 4 subsidiary companies balance sheet and holding company balance sheet put together, you need to prepare the consolidated financial statements, and what principles you need to follow, accounting principles and methods that you need to follow is clearly given in the accounting standard 21, and this particular standard exclude such consolidated financial statements because we have separate standard on that. Now before we get into the accounting for amalgamation, we need to have a clear understanding of certain terms. First thing is a transferor company. Transferor company is nothing but the vendor company or the selling company. You call it as a transferor company. Who is a transferor company? Transferor company means a company which is amalgamated into another company. The company selling its business is also called as a vendor company. Then the company into which the transferor company is getting amalgamated, you are terming it as a transferee company, and the company which requires or buys the business is also called as vendee company. Seller is termed as vendor, purchaser is said to be vendee company, or the same we call it as a purchasing company. Then business entities coming together. Generally speaking, there are two basic methods in which the business entities unite. In this background, the standard brings the concept of amalgamation under two broad heads. Basically, accounting standard 14 requires you to classify all the amalgamations into two broad categories, and those two broad categories are what? Amalgamation in the nature of the merger and amalgamation in the nature of the purchase. And accounting methods wise, if you look at, for amalgamation in the nature of the merger, you will follow the pooling of interest method, and in case of amalgamation in the nature of purchase, you are going to follow the purchase methods. And then first is the amalgamation in the nature of the merger. Under this category, there is a genuine pooling. When we say genuine pooling, not only assets and liabilities of the vendor company are getting pooled with the purchasing company's assets and liabilities, even the reserves, profit and loss account, those things are also getting merged is the point, which generally you don't see, because whenever we purchase anybody else business, what we need to account for generally is assets and liabilities which we have purchased from the other person. But peculiar feature of amalgamation in the nature of the merger is it's a complete merger, 100% merger, line to line merger, including the reserves, profit and loss account, credit balance or debit balance, that also will get merged is the point. Also the interest of the shareholders will also be merged is the point. Amalgamation in the nature of the purchase. Transactions under this category are in effect what? A mode by which one company acquires another company. As a consequence, the shareholders of the company which is acquired normally do not continue to possess the interest in the equity of the combined company in an identical proportion. In case of the purchase, what will happen? Only those assets and liabilities which the purchasing company want, it will purchase, and in lieu of that it will issue the shares to the liquidators of the vendor company. So it is not correct on our part to say that those shareholders, how they are there, will not exactly get in the same proportion here also the shares, because already here you have existing shareholders in the purchasing company. So by their becoming shareholders here, they will not maintain the same proportion of the shareholding which they have in the other company. It goes without saying. Business of the company which is acquired is not necessarily intended to be continued. With the amalgamation in the nature of the purchase, what will happen? There need not be any what you call intention to carry on the business of the vendor company. It is only acquisition of assets and liabilities. Whereas that is not the same case with the amalgamation in the nature of the merger, because in case of the amalgamation of the nature of merger, necessary condition is that the business of the vendor company should be continued by the purchasing company. Then amalgamation in the nature of the merger. How amalgamation of in the nature of the merger gets distinct from your amalgamation in the nature of the purchase. For that, what we are saying is accounting standard 14 gives you 5 conditions. If all those 5 conditions are met, then you term it as amalgamation in the nature of a merger. So basically, what distinguishes a merger from the purchase is the true substance of the transaction. It is helpful to know that UK Financial Reporting Standard 6 deals with the merger, and what FRS 6 says, merger is a business combination which results in creation of a new reporting entity formed from the combining of the parties in which the shareholders come together in a substantially equal partnership for a mutual sharing of the risks and the benefits of the combined entity. So not only the assets and liabilities are coming, even the shareholders of the vendor company will opt to become the shareholders of the purchasing company. AS 14 enumerates 5 specific conditions on fulfillment of which the event of 2 entities coming together is to be treated as amalgamation in the nature of a merger. So first thing is assets and liabilities. That is, all the assets and liabilities of the transferor company become the assets and liabilities of the purchasing company or the transferee company. And second issue is shareholders. Friends, here it is shareholders holding not less than 90% of the face value of the equity shares of the transferor company. It's not that 90% shareholders. When we say shareholders holding 90% of the face value of the equity shares, even 3 or 4 people who are holding 90% of the face value of the shares, by their opting to become the shareholders of the purchasing company, that is enough. So here one should be very careful. It is not 90% of the shareholders, but shareholders holding 90% of the face value of what shares? Only equity shares of the vendor company should opt to become the shareholders of the purchasing company by virtue of this amalgamation. And the third important thing is consideration. Purchase consideration, how purchasing company need to discharge? Only by issuing the equity shares. If purchase consideration in an individual shareholder's point of view, if it turns out to be in fractional shares, in that case, in order to discharge that fractional shares, consideration may be paid in cash. What I mean is, let us suppose there is a shareholder X. He is holding say about 7 shares, and the agreement there is every shareholder who is holding 2 shares is going to get 3 shares. 2 shares in the vendor company is going to get 3 shares in the purchasing company. Then this X should get how much? 7 divided by 2 is 3.5 into 3, that makes to 10.5. You cannot give 0.5 share. So in order to discharge that 0.5 share, the consideration may be paid in cash. And then friends, in the earlier second point also one should be very careful. That is, we say shareholders holding 90% of the face value of the equity shares should opt to become the shareholders of the purchasing company. In this context, try to understand, when we calculate this 90%, we should exclude what? What the purchasing company is holding the shares in the vendor company, that is to be excluded. See, point is, generally amalgamation will happen between 2 known companies. Prior to the amalgamation itself, purchasing company might be holding few shares of the vendor company. So what is the example here? Like, let us suppose X and Y want to go for amalgamation. X is the vendor company and Y is the purchasing company. The total share capital of the X is 1 lakh. Prior to the amalgamation, Y company is holding in the X company 20,000 shares of the X company. Now both the companies are getting into amalgamation. Then while you calculate this 90%, from that 1 lakh you should reduce the 20,000 which is already held by the purchasing company, and in the balance 80,000 which is held by the other than purchasing company, 90% of that outside shareholders, that is shareholders holding 90% of the face value, that is with reference to the outside shareholders, whether they opted to become the shareholders or not, that you have to check. So the point of interest is, you have to exclude while calculating this 90% of the share capital, face value and all, the shares which purchasing company is holding in the vendor company prior to the amalgamation. Now I move to the fourth thing, continuity of business. This is also most important thing. That is, the business of the transferor company is intended to be carried on even after the amalgamation by the transferee company. How, as a chartered accountant, we will be able to satisfy whether that intention to carry on the business is there or not? Of course, under the income tax law, in order to give the benefits for amalgamation, there are some conditions which are prescribed. Which conditions exactly makes us to feel that there is an intention to carry on the business? By saying that the assets which are transferred should not be transferred for a particular time, and the purchasing company should try to achieve a prescribed percentage of utilization of the installed capacity of the vendor company's assets. Like such, certain conditions are prescribed under the income tax law, where from that you can feel that whether there is an intention to carry on the business or not. So you should be aware of all those circumstances and situations are prevailing for us to conclude that there is a continuity of the business or not. Other way around, as a condition from examination point of view, if you want to look at it, it's only a mere statement saying that the fourth important condition that should be met with to call it as amalgamation in the nature of the merger is continuity of the business. And then the fifth one is line to line merger, that is without going for any change in the value of the assets and liabilities, how these assets and liabilities of the vendor company, how they are appearing in the vendor company books, as it is they must be incorporated into the books of the purchasing company. You should not bring any change in the book value of the assets and liabilities is the point that should go into your minds. Then of course every rule has got an exception. After all, this is a social science. You cannot have rigid rules like a natural science. So exceptional circumstance here, what is stated, let us suppose there is an asset in the vendor company books. A similar asset is held by the purchasing company. Purchasing company follows one particular method of depreciation for this particular asset. So far vendor company followed a different method of depreciation for a similar asset. In that case, in order to follow the uniform accounting policies, you can always bring a change in the book value of the assets and liabilities, except for the requirement to follow the uniform accounting policies. In no other situation you should bring the change in the book value of the assets and liabilities as it is, how it is, as they appear in the vendor company books, they should be incorporated into the books of the purchasing company is the point. Of course, what is amalgamation in the nature of the purchase, what is not amalgamation in the nature of the merger is amalgamation in the nature of the purchase. If any of the five conditions which we studied are not getting satisfied, then that is called as amalgamation in the nature of the purchase is the point. So basically the differences, again columnar manner and point to point distinction you want to bring. First thing is meaning wise, in case of amalgamation in the nature of the merger, there is a pooling of assets and liabilities of both the companies, as also the interest of the shareholders and the business of the amalgamating companies. So here assets and liabilities are getting pooled, interest of the shareholders are getting pooled, business is also getting pooled. Whereas in case of the amalgamation in the nature of the purchase, one company acquires the another company, but the shareholders of the amalgamating company need not continue to become the shareholders of the purchasing company, because consideration can be paid by cash also. Whereas here in case of pooling of interest method, which is applicable for amalgamation in the nature of the merger, since purchase consideration can only be discharged by issuing the equity shares, then we can safely conclude that shareholders of the vendor company become the shareholders of the purchasing company. Whereas in the other case, since consideration can be paid even by cash, need not necessarily the vendor company shareholders will become the shareholders of the purchasing company is the point. And then continuity of the business is one of the primary requirement of the amalgamation in the nature of the merger, whereas that is not the case with the what you call amalgamation in the nature of the purchase. Coming to the carrying amounts, assets and liabilities of the vendor company as it is, how they appear in the books of the vendor company should be incorporated into the books of the purchasing company, whereas that is not the case with the amalgamation in the nature of the purchase. At what value purchasing company agreed to take over with those values only assets and liabilities of the vendor company will be incorporated into the purchasing company's books. And then as far as participation in the management is concerned, since all the shareholders of the vendor company opt to become the shareholders of the purchasing company, at least if not all 90%, they continue to participate in the management of the new company after the amalgamation, whereas there is no need for the shareholders to become the shareholders of the purchasing company, shareholders of the vendor company to become shareholders of the purchasing company. It is not correct on our part to say that they are going to have either equal participation or more dominant participation. Like that we cannot say. As far as method of accounting is concerned, here it is pooling of interest method, there it is the purchase method is the point. And there are two methods of accounting. Basically one is pooling of interest method and another is the purchase method. In case of the merger, it is a pooling of interest method, and in case of the purchase, it is the purchase methods. How do we learn this pooling of interest method and the purchase method? As far as pooling of interest method is concerned, it is used to account for amalgamations in the nature of the merger, whereas purchase method is used to account for amalgamations in the nature of purchase. Friends, before we get in detail into this, let me tell you one aspect, that all these methods which we are discussing will have relevance only in the context of the purchasing company. How to incorporate the assets and liabilities taken over into the purchasing company. As far as these methods are concerned, they will have no relevance when it comes to the point of closure of the books of accounts of the vendor company or the transferor company. Then recording of assets and liabilities. That is, assets and liabilities and reserves of the transferor company are recorded at their existing carrying amounts, of course subjected to some adjustments in order to follow the uniform accounting policies. See, here the most important point is assets and liabilities, not only assets and liabilities but also reserves of the vendor company are going to come into the books of the purchasing company. Whereas in case of amalgamation in the nature of the purchase, for which purchase method is applicable, only those assets and liabilities which are being taken over, and that too also at their taken over values, it will be incorporated into the books of the purchasing company. And then profit and loss account of the transferor company. Profit and loss accounts, reserves of the transferor company will be incorporated into the books of the transferee company, whereas that is not the case with the purchase method. In the purchase method, you don't see the reserves and the profit and loss account balance of the vendor company getting incorporated into the books of the purchasing company. As far as the statutory reserves are concerned, friends, please remember, what do you mean by statutory reserve? Any reserve which you require to maintain as a requirement of the statute. If the statute requires you to maintain a particular reserve, that you call it as a statutory reserve. Now the point here is, in case of amalgamation in the nature of the merger, you don't have any problem, because both statutory and non-statutory reserves, every reserve will come from vendor company into the purchasing company, whereas the problem will be there in the case of purchase method, because in case of the purchase method, what will happen? In case of the purchase method, since you will not incorporate any reserves and profit and loss account of vendor company into the purchasing company, you should make a special entry to incorporate the the statutory reserves of the vendor company into the books of the purchasing company, because as per the statute, even if the company undergoes for amalgamation, these reserves should appear in the new company's books. So how you are going to incorporate such statutory reserves? Further, the standard says that you need to do what? You need to pass a dummy entry. What is the dummy entry? Amalgamation adjustment account debtor to statutory reserve account is the point. And that is the treatment of statutory reserves. Whereas with respect to the non-statutory reserves, what we are saying, other than statutory reserves, in case of amalgamation in the nature of the merger, all non-statutory reserves also will be carried into the books of the purchasing company, whereas in case of purchase method, the non-statutory reserves are not going to come into the books of the purchasing company is the point. And then goodwill in the capital reserve, this is also one most important issue. What is goodwill and what is capital reserve? Friends, try to understand. Whenever you acquire something, you should always think of whether you have paid more or less for acquiring a particular thing. That more or less with reference to what you are going to check. See, when you acquire a business, you are acquiring assets and liabilities. So you have net assets. In case your purchase consideration is more than the net assets taken over, that extra what you are paying is towards the goodwill. Actually, it is a capital loss. The royal name which we gave for capital loss is the goodwill. Whereas if you are paying less and getting more, it is treated as capital profit, which you need to transfer to the capital reserve. But this goodwill or capital reserve concepts will be there only when it is a case of amalgamation in the nature of the purchase, and that too also if it is that you are following the purchase method of accounting. In case of pooling of interest method, which is applicable for amalgamation in the nature of the merger, you don't need to look at goodwill or the capital reserve. Then what you need to do? What you need to do is, what the shareholders of the vendor company are holding in their company and what those shareholders are going to get in this company. You find out the difference between these two. If they are being paid more than what they are holding, then you have to debit the general reserve. Consolidated general reserve need to be reduced. See, it is a similar concept like this. Without collecting any money, how you are able to issue the shares, which we term it as a bonus shares? Bonus shares you can do it only by capitalizing the reserves. So this is also a similar situation. That is, amalgamation is happening, assets and liabilities you are taking over, you are paying more than what they are holding there. That means it is almost like issuing bonus shares only. How the bonus shares will be? Only by capitalizing the profits. So in case if the shareholders of the vendor company are getting more than what the shareholding they have in the purchasing company, to that extent the general reserve is to be debited. Let us suppose if they are getting less than what they are holding, then to that extent purchasing company stand to gain. That gain need to be transferred to which account? General reserve account is the point. Since already this topic you studied at the PE2 level, slightly we are doing it fast, and you will also be looking at or listening that accounting standard 14 complete standard. There I explained more clearly these concepts. As far as adjustment to the assets and liabilities are concerned, it is only possible in case of amalgamation of in the nature of the merger just to follow the uniform accounting policies. Whereas in the other case, that is in case of amalgamation in the nature of the purchase, adjustment becomes necessary is not the point. At what value they are agreed to be taken over, you are going to incorporate is the point. And management intervention is concerned, there is no domination by the management of either of the amalgamating company is the point. In the sense, in case of amalgamation in the nature of the merger, since those shareholders are also going to become the shareholders here, the question of domination does not arise. Whereas in case of amalgamation in the nature of the purchase, more it is like purchasing of assets and liability. So let us not look into who dominates whom. Right? Now AS 14, a diagrammatic presentation like see, diagrammatic presentations and all are given for revision. Again and again we are revising the same points, that you have a quick glance at what it is. There are 5 conditions to call it as amalgamation in the nature of the merger. All assets and liabilities of the selling company should be taken over by the purchasing company. Shareholders holding 90% of the share capital will become the shareholders of the purchasing company. Of course, what you need to exclude is what the purchasing company is holding in the vendor company. You should exclude while calculating that 90% of the face value and all. And then consideration in the shares. As far as amalgamation in the nature of the merger, consideration must be necessarily be discharged only by issuing the shares, except that for discharging the fractional shares you can pay it in cash, and the intention to continue the business should be there. No adjustment should be there to the book values except to follow the uniform accounting policy. Whereas in case of the purchase, if any one of these conditions are not met, it is called as a purchase. As far as accounting is concerned, pooling of interest method is the accounting methodology for merger, whereas purchase is the methodology. Purchase method is the accounting methodology for amalgamation in the nature of the purchase. Basically here what is it? You need to look at what the shareholders of the vendor company are having in their company. It is to be compared with what they are getting in this company, and the adjustment should be made through the profit and loss accounts or the general reserves. Whereas there you get goodwill or the capital reserve. Of course, how you calculate the goodwill or the capital reserve in case of the purchase method, what the purchase consideration, that should be compared with the net assets taken over. If purchase consideration is more, it is goodwill. Purchase consideration is less, it is a capital reserve. And once goodwill comes, please remember accounting standard 14 requires you to write off that goodwill. Not only accounting standard 14, even accounting standard which deals with the intangible assets also says what? Only the purchased goodwill should be accounted for and should be brought into the books, but it should be written off at the earliest, say 5 years. And if you need more period than that 5 years, you need to necessarily state by way of a note why you are taking more time to write off that particular goodwill. But in any case, inherent goodwill should not be brought into the books of accounts. But with respect to the amalgamation, what goodwill you are looking at is not inherent goodwill, it is a purchased goodwill only, because it is something which you are paying more than what you are getting is the point. And then non-cash considerations whenever are being paid, like instead of paying them in cash and shares, sometimes what may happen is some assets might be given in the form of purchase consideration. At all such situation where non-monetary consideration is being paid, that consideration valuation and all will be done at the fair value of the assets which the purchasing company is giving up to take over the vendor company is the point. And similarly, if you have any uncertainties associated with the process of this amalgamation and all, what your accounting standard 4 says about how to account for the uncertainties, you should create a provision for any possible loss and all. And all those uncertainties must be clearly given by way of a note also is the point. The uncertainties may be with respect to the considerations and all, because sometimes what will happen, friends, that purchase consideration they will decide in this way. After doing 1 year of the business, this consideration is fixed as a fixed percentage of the profits that the purchasing company is going to get on account of carrying on the business of the vendor company. In that case, what the purchase consideration payable, there will be certain uncertainties is the point. As it is initially itself purchase consideration is being decided, there is no problem. But many service sector acquisitions and all, what will happen? Today, let us suppose I am doing practice. Somebody want to acquire from me the practice. Then they will not immediately be able to tell how much they are going to pay to me. in the form of consideration and all. What they will only say, let us do your practice for 1 year, let us understand what we are going to get. Based on what we are going to get, a fixed percentage we are going to give you for 3 years or 4 years. So in that situations the uncertainties are there with respect to the considerations. And as far as the disclosure requirements are concerned, this is also one important aspect. At the final level you have to give a due consideration, because at the PG2 level or PCC level your concern is more towards the accounting, whereas once you come to the final, they insist on whether you know properly what is the disclosure and all. So as far as the disclosures are concerned, for all amalgamations you should clearly disclose name, general nature of the business of the amalgamating companies, what is the effective date of amalgamation, what is the method of accounting that you are following, and particulars of scheme statically sanctioned, because friends, please remember, amalgamation is not a child's play. It is something which requires the High Court's approval, and court first will intimate to all the people whose interests are involved, and only when they don't give any objections or their objections are properly addressed by the company, then only it will give the permission for making this amalgamation and all. So in that context, whether all the necessary permissions are being taken or not should also be clearly specified. And the amalgamation after the balance sheet date, before issuing of the financial statements, it is something like you have studied in one of the standard, that is prior period items and events occurring after the balance sheet date. So in case if any amalgamation happens after the balance sheet date but prior to the what you call the accounts getting finalized, you need to follow what is being stated in the accounting standard 5, the accounting standard 4. Then for pooling of interest method, first time when you are giving the financial statements immediately after the merger, that is, suppose amalgamation in the nature of the merger happened, for the first time the financial statements are being presented by the purchasing company, then additional disclosures which are prescribed is number of shares which are issued to the shareholders of the vendor company and percentage of equity shares exchanged to give the effect to the amalgamation, and what is the difference between consideration and the net asset value, and what is the treatment that you are giving, these things also. Of course friends, this is only a disclosure, but as it is, nowhere pooling of interest method is asking you to do what? Like compare the purchase consideration with the net assets value. You have to necessarily compare what the shareholders of the vendor company are holding in their company, that is to be compared with what they are going to get in this company. The difference must be adjusted through the general reserves only. But as a disclosure requirement, you just also intimate to the readers of the financial statement, even if it is an amalgamation in the nature of the merger for which pooling of interest method you are following, what is the net assets value that you got on account of this particular merger need to be informed. And for purchase method, for the first time when the financial statements are going to be given by the purchasing company after the amalgamation, what is the consideration paid and what is the contingently payable. As already I explained, what is contingently payable means sometimes the consideration they will fix in such a way that consideration is not on the basis of the assets or the net assets taken over, but on the basis of the profitability. In that situation, that contingently what is payable should also be informed to the readers of the financial statements by way of a notes. And difference between the consideration and the net assets taken over, and what is the treatment that you have given, and how much time you are thinking to amortize the goodwill that is arising on account of the amalgamation also need to be clearly be specified. Now, in the total amalgamation friends, the complex aspect is always computation of purchase consideration, because specifically accounting standard 14 defined what is purchase consideration. Prior to the introduction of the accounting standard 14, what is purchase consideration? What all paid by the purchasing company to the shareholders of the vendor company or to any other persons who are connected with the vendor company is all to be treated as a purchase consideration. That is, in those days when we were doing amalgamation prior to the AS 14 being introduced, payment to the debenture holders, payment to the shareholders, payment to the creditors, payment towards the liquidation expenses, all we used to add and say that this is purchase consideration. But now your accounting standard 14 says what? Purchase consideration means only what is paid to the shareholders of the vendor company by the purchasing company. Then what will happen, sir? For all that which purchasing company has paid to discharge the debenture holders and to discharge the creditors and to discharge the liquidation expenses, where will be the implication? Point here is, when you are accounting for in the books of the purchasing company, in case if debenture holders of the vendor company are discharged by the purchasing company, then what all that is paid must be reduced from the net assets taken over. It's not going to be added to the purchase consideration. It will be reduced from the net assets taken over. Of course, earlier or now, ultimately it amounts to the same. Either you increase the purchase consideration or you reduce the what you call net assets taken over. Because earlier what we used to do, let us suppose a situation for you to make you to understand. Let us suppose a net assets taken over is 100 rupees. What I agreed to pay is 150 rupees. What is the difference? 150 minus 100 is equal to 50 rupees. That 150 includes 100 towards the shareholders, 50 rupees towards the debenture holders. So put together is how much? 100 to the shareholders, 50 to the debenture holders, 150 minus net assets taken over is how much? 100. 50 rupees is the what you call the goodwill. Now what we are doing? 100 only we take it as a purchase consideration because what is paid to the shareholder is 100. But what I am asked to do, from the net assets taken over of 100, you reduce what is paid to the debenture holder of 50, so that net assets taken over will become what? 50. From 100 if you reduce 50, what will happen? The goodwill will be the 50. So prior to the introduction of accounting standard 14, what all paid used to be there in the purchase consideration. Now with introduction of the accounting standard 14, what all paid only to the shareholders only will be there in the purchase consideration. What all extra being paid to discharge the debenture holders of the vendor company or creditors of the vendor company or liquidation expenses of the vendor company will go to reduce your net assets taken over. Thereby the difference between the purchase consideration and net assets taken over always continues to be the same, either prior to the what you call introduction of the AS 14 or after introduction of the AS 14. But since it will have the same effect, now you cannot add all what paid by the vendor purchasing company in the purchase consideration, because strictly you have to adhere to the accounting standard 14. So the point that I am driving here is purchase consideration means only what is paid by the purchasing company to discharge the shareholders of the vendor company. What other payments, they are to be reduced from the what you call net assets taken over. Now coming to the point of accounting for amalgamations, first section I am into the computation of purchase consideration. Try to understand, there are three methods of